In this video, I'll be sharing my top 6 criteria for picking 10x growth stocks in your portfolio. I'll also be providing examples of amazing growth stocks that fit these criteria, as well as ones that you might want to avoid. And whether you're watching this video in 2022 or in a decade from now, these core principles will remain valid for growth investors. And I encourage you to watch this video all the way through to make sure you truly understand the fundamentals before picking a growth stock that ends up being a bad investment. With that said, please hit the like button and subscribe if you do enjoy, and let's get into it. Our first key criteria for picking solid growth stocks is to understand a company's total addressable market, or the TAM opportunity. Without a doubt, the types of growth stocks that can produce a 10x or even a 100x return are the ones with a massive TAM opportunity. Basically, the TAM tells an investor here's how much annual revenue this company could potentially make over the long-term future. Assessing a company's TAM is absolutely crucial to finding winning growth stocks, and that's because companies with small TAM opportunities won't be able to continue growing past a certain point, whereas companies with large TAMs will be able to continue growing for many years to come. For example, in Shopify's Q4 2021 presentation, one of the first things they highlight is their TAM opportunity, and I love to see this as an investor. Shopify allows merchants to create e-commerce websites where they say there's a $160 billion annual revenue opportunity for small and medium-sized businesses on the Shopify platform long term. They even show how they calculated this number, where they use their average revenue per merchant of $2,354 in 2021 and multiplied it by 68 million retail businesses globally. However, since Shopify also caters to entrepreneurs as well as larger enterprise clients, this TAM is likely quite conservative in reality. Now, once we know the company's total TAM opportunity, it's very important to compare that number to the company's total revenue that they're producing today annually, and that will give us an idea of how much growth is left over. In Shopify's case, they produced revenue of $4.6 billion in 2021, which represents 2.9% of the company's TAM opportunity. However, Shopify might only end up capturing 30% of their $160 billion TAM, being worth $48 billion, while other industry competitors would capture the rest. In this case, Shopify has grown to just under 10% of their total TAM opportunity, meaning they have decades of growth ahead. And keep in mind too, the TAM opportunity doesn't always stay constant. In fact, TAM opportunities regularly increase over time with growing populations, inflation, growing GDP, as well as the products and services that that company offers. For example, Tesla's TAM opportunity keeps on increasing as they enter new industries. The company started out as an EV manufacturer, but soon moved into the energy business, and now it's carving a path into brand new industries, being autonomous vehicle technology and robo-taxis, which didn't even exist a decade earlier. So finding companies with massive and growing TAM opportunities is the first key criteria for picking winning growth stocks. Now, our second key criteria is to find companies with quickly growing revenues. What you'll quickly learn about growth stocks is that revenue growth matters most, and that means it grows its revenues far faster than the average market growth. Now, over the past 20 years, the top 500 companies in the US, or in other words, the S&P 500, had an average revenue growth rate of 3.5%, while the median growth rate was 4.8%. But as of today, this value is 10.8%, which means a growth stock should be growing its revenue far more than 10.8% per year. So a good guideline is to find a company that's been growing its revenue 25% or more per year over the past 5 years. For example, if we look at Shopify once again, in 2018, they grew revenues 59%, in 2019, 47% growth, in 2020, 86% growth, and in 2021, 57% growth. And as we can see, this was clearly reflected in Shopify's stock price having grown over 950% in the past 5 years. Let's also look at Tesla, for example. Here we can see that Tesla had revenues of $7 billion in 2016, while they grew it to $53.8 billion in 2021. Using a compound interest calculator, we can find that Tesla ended up having a 50% compounded annual growth rate over the last 5 years, which is insane. As a result, Tesla stock has widely outperformed the rest of the market, being up about 1,800% over the past 5 years. We can also look at Amazon's growth over the past 5 years, where they produced revenue of $136 billion in 2016 and grew it to $470 billion in 2021. And this ends up being a 28.1% compounded annual growth rate over the last 5 years for Amazon's revenue, which is very impressive for such a large company. And without a surprise, Amazon stock has widely outperformed the rest of the market, being up about 275% over the past 5 years. Overall, high revenue growth rates are the holy grail of growth investing, and this can lead to superior stock price performance over the long term. That leads me nicely into my third key criteria for picking growth stocks, and that would be profit margins. While high revenue growth is very important, if a company can't generate profits from that revenue, it's basically useless. So in this section, I'll be explaining what you should be looking for in terms of the three profit margins, which are the gross margin, the operating margin, and the net margin. Starting off with the gross margin, this is calculated by dividing the gross profit by the revenues, where the gross profit is simply the revenues minus the cost of goods sold. And the gross margin just indicates how profitable a company could potentially be in the future. Typically, you want to find companies with gross margins above 30%, otherwise the company might struggle to achieve profitability. For example, Meta Platforms had a Q4 2021 gross margin of 81%, which is honestly the highest gross margin I've ever seen, and that's because Meta has a very low cost of goods sold, being an online advertising platform. Therefore, because they have such a high gross margin, Meta can increase their expenses massively and they'd still be profitable. Another example is Shopify, which had a Q4 2021 gross margin of 50%, since they also have a software business with low cost of goods sold. On the other hand, Tesla only has a gross margin of 27.4% since their business is capital intensive, but I'm not too concerned about this since they do have a gross automotive margin of 30%. Now, if we also consider Greenlane Renewables, a small cap Canadian stock, they only have a gross margin of 25% and they've been struggling to achieve profitability. Next, we need to look at the operating margin, which considers cost of goods sold as well as operating expenses, and this is calculated by dividing the operating income by the revenues. Typically, you want to find companies with operating margins above 15% since the S&P 500 operating margin is about 10% on average, but this only applies to profitable companies. For example, Meta had a Q4 2021 operating margin of 37.4%, which is outstanding, while Tesla had an operating margin of 14.7% in the same quarter. However, in Shopify's case, they only had a Q4 2021 operating margin of 1% since this company is still on the verge of profitability and they're still focusing on revenue growth. Finally, we have the net profit margin, otherwise known as the net margin, and this is calculated by simply dividing a company's net income by its revenues. Typically, a strong net profit margin would be considered 10% or above, but once again, this only applies to profitable companies. For example, Meta has a Q4 2021 net margin of 30.6%, which is once again outstanding, while Tesla has a net margin of 14.5%, which is essentially equal to their operating margin. So overall, it's important to understand that the gross margin applies to all companies, whereas the operating and the net margin only apply to profitable companies. And it's important to see that these margins are staying flat over time, or they're increasing and not decreasing, so that means that you should see the profits growing faster than the revenues. Now, the fourth key criteria is to find growth stocks with reasonable valuations. There are hundreds, if not thousands, of amazing businesses that exist today, but only a handful that are actually great investments. Now, since growth stocks have higher revenue and earnings growth rates than the average company, that also means that they are typically going to have higher valuations than the average company. But as the great Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So now let's investigate the 5 most important valuation metrics for growth stocks. Firstly, the price to sales ratio tells us how many times a stock's market cap is trading for relative to the company's annual revenues. For example, dividing Shopify's market cap of $87 billion by their 2021 revenue of $4.61 billion gives them a current price to sales ratio of about 19. Now, typically, a price to sales ratio above 10 would be considered quite high, but it does depend on 2 different factors, those being the revenue growth rate and the company's profit margins. In Shopify's case, they've nearly tripled their revenues in only 2 years since the pandemic began, and they're still growing revenues well above 30% per year. Also, from before, we calculated Shopify's gross margin to be 50%, which is quite high, and this shows the business could be quite profitable in the future. Higher profit margin businesses should trade at higher price to sales ratios because they'll be able to derive more profit from each dollar of revenue than a business with a lower profit margin. Therefore, a seemingly high price to sales ratio right now might actually lead to a lower price to earnings ratio in the future. The second valuation metric is the enterprise value to sales ratio, or the EV to sales ratio. While very similar to the price to sales ratio, the EV to sales ratio is much more accurate because it accounts for the cash and the debt on a company's balance sheet. The enterprise value, or EV, is calculated by taking the market cap, adding in the total long and short-term debt, and subtracting the total cash. Then dividing the EV by the annual revenues gives you the EV to sales ratio. For example, let's take a look at Ford stock. Currently, Ford has a market cap of $66.7 billion, while they produce revenue of $136.3 billion in 2021, which gives them a price to sales ratio of 0.49. However, when we take Ford's market cap, add back in their debt, and subtract their cash from the balance sheet, we get an EV of $157 billion, and therefore an EV to sales ratio of 1.15. Now see how their EV to sales ratio is over double their price to sales sales ratio? That's because Ford has a ton of debt on the balance sheet and not nearly enough cash to pay it off. Therefore, its valuation is significantly higher than one would have estimated with the price to sales ratio. Now, the third valuation metric is the most common in the investing community, and that is the price to earnings ratio, or the PE ratio, but there are certain caveats you need to understand. For a profitable growth company, I like to watch the forward price to earnings ratio. This is calculated by dividing the stock price by the analyst consensus earnings per share, or EPS, over the next 12 months. You can easily find these EPS estimates on Yahoo Finance under the analysis tab. And whenever a company's forward PE ratio is lower than its trailing PE ratio, that means the company is expected to grow its earnings over the next year, and that's a good thing. But you must understand that there are two different types of EPS that are reported: GAAP EPS and non-GAAP or adjusted EPS. Typically, I like to use adjusted EPS for growth companies since this accounts for many one-time expenses and or non-cash expenses that can make a company's earnings look worse than they are in reality. For example, Tesla has a GAAP trailing PE ratio of 220, but on an adjusted EPS basis or a non-GAAP basis, Tesla has a trailing PE ratio of only 160, which is significantly lower. So it's important for you to know that analysts typically report adjusted EPS numbers, and these are a more accurate representation of a company's actual earnings. Now, the fourth valuation metric is one of the most important in this list, and that would be the price to earnings growth ratio, or the PEG ratio. The PEG ratio is a modified version of the PE ratio that accounts for a profitable company's earnings growth rate. You can calculate the PEG ratio by dividing a company's trailing PE ratio by its future 5-year expected earnings growth rate, which can be found on Yahoo Finance. For example, Google has a trailing PE ratio of 25, while it has a future expected EPS growth rate of 20% per year over the next 5 years. So now 25 divided by 20 gives Google stock a PEG ratio of 1.25. And typically a PEG ratio of 1.5 or lower is considered cheap for a growth stock, so that means Google is priced pretty well right now. But do keep in mind, for companies that have higher EPS growth rates, their PEG ratios will correspondingly trade a lot higher. I made an entire video explaining this concept, so if you are interested, I'll link to it below. But just know that a PEG ratio of 2.5 or even 3 for a company that's growing its earnings above 50% per year is acceptable. Finally, the fifth valuation metric I like to use is the EV to earnings ratio. You would calculate this by dividing the company's EV by its trailing 12 months of net income. For example, Google currently has a market cap of $1.86 trillion, but after subtracting its total cash of $139.6 billion and adding in its total debt of $28.5 billion, we come to an EV of $1.75 trillion, and as you'll notice, this is lower than the market cap. Then if we divide Google's EV by their 2021 net income of $76 billion, we get a trailing EV to earnings ratio of only 23. Comparing this to Google's trailing PE ratio of 25, we can see that Google stock is actually trading more cheap than it seems just because of how much cash they have on the balance sheet. So I always like to check the EV to sales and the EV to earnings ratios to be most accurate when I'm calculating growth stock valuations. Alright, now the fifth criteria for picking growth stocks is to understand the company's capital structure. And by capital structure, I mean, how is this business financing its growth? Is it using debt or is it using equity? It's very common to find growing businesses diluting their shareholders to raise capital, but this can have a very negative impact on the per share growth metrics. For example, if we take a look at Palantir, a very popular growth stock, this company issues tons of stock-based compensation for its employees. In Q4 2021, the company issued $167 million of stock-based compensation, which represents almost 39% of their revenue. As we can see, Palantir had 1.76 billion shares outstanding in Q4 2020, but then in the most recent quarter, they now have 2.01 billion shares outstanding, representing 14% dilution year over year. Now, what this means for a growth stock like Palantir is that their per share revenue growth is not nearly as high as their reported revenue growth of 34% per year. In fact, it would only be about 17.5% revenue per share growth year over year, which isn't that great. On the other hand, we can compare this to Shopify stock, which has reported similar revenue growth in the recent quarter of 41% year over year. In Q4 2021, Shopify barely diluted shareholders at all, being less than 1% year over year, and for the full year of 2021, Shopify diluted about 3% year over year. Therefore, Shopify's revenue per share growth was about 37% year over year and much better than Palantir's 17.5% revenue per share growth. So it's important to find growth companies with minimal dilution, at most 5 to 10% per year, otherwise this can have a major impact on the per share metrics. And this is why I typically prefer investing in profitable businesses, because then they won't need debt or equity to finance their operations, and therefore dilution shouldn't be necessary. However, it's important to note that dilution for an acquisition is a totally different story, and that can be accretive to shareholders, meaning it would actually benefit EPS and therefore it wouldn't be a concern. So dilution for acquisitions isn't necessarily a bad thing, but other forms of dilution generally isn't a great thing for shareholders. And finally, we have the sixth criteria to pick growth stocks, and that would be to find companies with a moat. A moat is one or more specific competitive advantages possessed by a business that allows it to protect its long-term profits and market share from competitors. In fact, none of the other criteria that I discussed today even matters if a company does not have some type of competitive moat to protect it from competitors. So here are 5 types of competitive moats we should be looking for in our growth stocks. The first type of moat is cost advantage. A business that can maintain low cost for consumers that competitors cannot replicate has a cost advantage moat. And a great example of this would be Costco, because they sell everything in bulk to their customers while charging a membership fee, so Costco is able to guarantee the lowest prices on food and other goods for its members. The same goes for Amazon, which also charges an annual membership fee but usually matches every retailer's low prices on goods while offering 2-day free shipping and unmatched customer service to boot. Companies with sustainable cost advantages can maintain very large market share of their industry by forcing out any new competitors who try to move in. And this is absolutely true for Amazon, which has garnered 41% of the e-commerce market share to date, and its market share continues growing year after year. The second type of moat is economies of scale. Once a business achieves a certain size, it's able to reduce input costs per unit sold, which naturally makes it more profitable. For example, Tesla is currently the largest EV manufacturer in the world, which has allowed them to reap massive profits to date. And for every additional vehicle Tesla sells, their margins increase because of the fixed business costs such as salaries and overhead are being divided by a larger number of vehicles sold, thus the average profit per vehicle sold increases. And the same applies to oil and gas companies, where the larger amount of oil output they can generate means their fixed costs are then divided by a larger number of barrels sold, thus increasing overall profitability. So economies of scale can apply to basically any type of business that has a scalable product and any type of fixed business costs. The third type of moat is a switching moat. When a company's product or service presents difficulties or high costs to switch to a competitor's similar product or service, therein lies a switching moat. Once a company with a switching moat grabs hold of its customers, it's usually able to keep their business for a very long time, which indicates a sticky business model. For example, one company with a very strong switching moat is Adobe. Many of its products, such as Photoshop and Premiere Pro editing software, are difficult to learn and therefore a nuisance to try and switch to another competitor's products. Another example is Amazon's AWS, where a company will get used to using AWS, and any migration to another cloud computing platform would likely cause a lot of headaches and cost a lot of money. The fourth type of moat is network effects. A business's product or service that delivers more value per additional user or customer tied to that product or service is said to have network effects. For example, any social media company you can think of has network effects. The YouTube platform becomes enormously better with more viewers and content creators, and Facebook also becomes much better with more friends using the platform. But the same can also be said about MasterCard and Visa, which both have very strong network effects. Each additional merchant on the payment network allows cardholders another place to use Visa or MasterCard, while the same is true for merchants benefiting whenever more cardholders are added to the network. So if you look at the stock prices of all these companies I mentioned, it's clear that network effects have taken a hold of the businesses, and they've only gotten bigger and bigger over time. The fifth and final type of moat is created by intangible assets. These types of intangible assets could be patents, brand recognition, or access to top talent within an industry. Strong brand name recognition allows these types of companies to charge a premium for their products or services they sell, and thus this boosts the profits. For example, we all know Apple's brand recognition and brand value allows them to consistently sell more and more iPhones, MacBooks, iPads, Apple Watches, and other premium priced products each year. Tesla has equally developed a premium brand value in recent years, where the demand for their products has enabled them to raise prices multiple times over the past few years. Now, in terms of access to top talent within an industry, Tesla has shown just how valuable this intangible asset is to their moat. Tesla is unmatched when it comes to EV and automotive engineering, where they've developed the safest cars on the road with the best specs of any automaker. They're also constantly coming up with new ideas and new technologies to reduce cost and speed up operations, which all comes as a result of their top talent and the amazing company culture. So in summary, the 6 key criteria for picking 10x growth stocks are as follows. follows. Firstly, ensure the company has a large and growing TAM opportunity. Second, find companies with revenue growth rates above 25% per year and that have consistently grown their revenues quickly in the past. Third, find companies with strong profit margins, that is, gross margins above 30%, operating margins above 15%, and net margins above 10%. Fourth, find wonderful companies with good valuations by using the price to sales ratio, the EV to sales ratio, the PE ratios, the PEG ratio, and the EV to earnings ratio. Fifth, ensure the business's capital structure isn't diluting shareholders tremendously to grow. And sixth, ensure the business in question has a competitive moat, which could include cost advantages, economies of scale, switching moats, network effects, or intangible assets. If you follow all of these steps correctly, I can guarantee you you're going to find some amazing growth stocks that could 10x or more into the future. So anyways, if you did watch this entire video, give yourself a pat on the back and make sure to smash the like button for all of the work that went into this. Also, please consider subscribing for more stock market investing content coming very soon. And with that said, I will see you guys in the next one.